Well, hi traders, Chris Weston from the research team here at Pepperstone. Now, the world's financial markets eagerly await the highly anticipated FOMC meeting in the session ahead. And of course, shortly after that situation, the Fed Chair Jay Powell was stepping up to deliver his question and answer in his press conference to the world media, where he'll be grilled on all things economics, the slowdown we're seeing in hiring and obviously the deterioration in the labour markets, balance sheet risks, propensity for early enter or a formal end to QT, given that falling reserves, and also the influence that Trump seems to be having and that loss of independence, which has been a big market thematic of late as well. Of course, he's going to be pretty coy about that. But as traders, what we're looking at is the propensity for movement, the expected movement in markets, whether there's a skew in risk over that situation. And that helps us manage our risk, whether we want to keep those position sizing, how we want to trade this, and of course the risk management 101. Now, there's a number of ways we're going to be looking at that. First of all, we've got to look at the moves in markets. Of course, euro dollar's pushed up to 119. The dollar's been in all sorts of trouble. No one really likes it at the moment, can't find a friend, and the market's amassed a decent short position playing through in the US dollar on a broad basis. We can see that dollar Swiss year-to-date lows, dollar yen's broken out of its recent range, and of course, obviously dollar's in 69 cents. But on a cross-asset basis, we're seeing good buying across the Treasury curve. The two-year Treasury is trading at 350, not a million miles away from year-to-date lows. Gold's all-time highs, and the equity market's also all-time highs as well. So will the statement live up to those market pricings on a cross-asset basis? Now, one thing we are looking at very closely is the swaps market, because this is really all about rate cuts. The idea that the Fed need to get the Fed funds rate down to a neutral capacity far quicker than they had anticipated before. Now, if we have a look at the swaps pricing, the interest rate swaps pricing, we can see 105% chance priced in for a rate cut for this meeting. So any other situation other than a 25 basis point cut, and we'd probably fall off our chair, we'd be very, very surprised indeed. The market's completely expecting that. In fact, there's a small chance of a 50 basis point cut being priced in. But we can see 69 basis points of implied cuts by year end. So that tells us the market's seeing a roadmap where we're going to get a cut in September, another cut in October, and then a 2 and 3 chance by the end of the year. And that Fed funds rate getting down to a neutral capacity around sort of 3% by mid-year of next year. Will the tone of the statement reconcile to that market pricing that's already pretty dovish? It's very hard to see the Fed coming out of a dovish surprise given that market pricing. Will Jerome Powell's appetite to get that Fed funds rate meet that market pricing? Will we see that in the dot plots, the new set of dot plots projections? Will we see them take that down to imply 2 more cuts by the end of the year at 362, or will they maintain the current situation? What will they say for next year as well? So all of these factors will need to reconcile against the already aggressive market pricing, that positioning, that dollar positioning. My best way to trade this is to be looking to sell rallies in the US dollar on the day, buying dips in gold, and also in dips in equity markets, because all roads at the end of the day lead to the Fed cutting rates going forward. We'll see if the tone of that meets up to market pricing. Will it outdove an already dovish market?